Interest rates and measures of return. Part 2. Risk-free rate and risk premia. Welcome back. Last time we explored how a required rate of return, a discount rate, and an opportunity cost are really three lenses on the same number. Now let's think about what actually goes into that number. In early 2023, a portfolio manager at a mid-sized pension fund is staring at two bonds on her screen. Both 5-year maturities, both easy to trade, but the Treasury yields 3.5%, while the corporate bond yields 5.3%. Same maturity, same liquidity. So why is the market demanding an extra 1.8%? To answer that, we need to crack open an interest rate and see what's inside. So what is the real risk-free rate? It's the baseline return investors require simply for postponing consumption, in a hypothetical world with no inflation and no uncertainty. Think of it as the pure time value of money. Even if prices never changed and no borrower ever defaulted, you'd still want some compensation for waiting. Now let's add the inflation premium. This compensates investors for the expected loss of purchasing power over the investment horizon. If the real risk-free rate is 1% and a 3-month T-bill yields 3.2%, the embedded inflation premium is approximately 2.2%. That's the market's expectation for how much purchasing power you'd lose. Here's the formula. The nominal risk-free rate equals the real risk-free rate plus the inflation premium. On top of the nominal risk-free rate, a bond's required return includes 3 additional risk premia: a default risk premium for the chance the issuer can't pay, a liquidity premium for how hard the bond is to sell quickly, and a maturity risk premium for the extra uncertainty of holding a bond over a longer horizon. So here's the full formula. Required return equals the real risk-free rate plus the inflation premium plus the default risk premium plus the liquidity premium plus the maturity risk premium. That's the complete anatomy of any interest rate. Now let's isolate that spread. Back to our pension manager. Same maturity, same liquidity, but the corporate issuer can default. So that 1.8% spread is almost entirely the default risk premium. Here's the exam technique. Same maturity eliminates the maturity premium. Similar liquidity eliminates the liquidity premium. Default risk is what differs, so the spread is the default risk premium. And this leads to a critical relationship. For a given set of cash flows, a higher required yield translates directly into a lower bond price. More risk means investors pay less up front. Here's the price yield curve for a 5-year bond paying a 4% coupon. When the required yield equals the coupon rate at 4%, the bond is priced at par, $100. But if the required yield rises to 5% due to added risk premia, the price drops to roughly $96. Here's a practical exam tip. When two bonds are otherwise identical, isolate the single feature that differs to identify which premium explains the yield spread. The exam loves this pattern. Now let's put this into practice with a CFA-style question. Let's see if you can identify which risk premium explains a yield spread when most features are held constant. Two bonds issued by the same company have similar liquidity. Bond A matures in 2 years and yields 4%. Bond B matures in 20 years and yields 5.5%. The higher yield on Bond B is most likely due to Option A, a higher default risk premium; Option B, a higher liquidity premium; Option C, a higher maturity risk premium. Now let's think through these. Same issuer means both bonds carry the same default risk, so we can eliminate A. Similar liquidity rules out B. What differs is the maturity, 20 years versus 2. That longer maturity exposes investors to far more interest rate risk and price uncertainty. So the correct answer is C, the maturity risk premium. Let's recap. First, an interest rate equals the real risk-free rate plus an inflation premium plus default, liquidity, and maturity risk premia. Second, when bonds are otherwise identical, isolate the single differing feature to name the premium. Third, higher required return always means lower price. More risk, less you pay up front. And next time, We'll explore how to measure average returns, arithmetic, geometric, and harmonic in Part 3. And that's the anatomy of an interest rate. See you in Part 3.